Welcome to a new deep dive. Today we're plunging headfirst into a story packed with, well, intrigue, immense ambition, and a really dramatic market surge. Some people even called it a conspiracy. We're going to explore how silver, a metal often flying under the radar in investment circles, experienced this just astounding 30x price increase in just one decade. Our main source here is a fascinating article, The Untold Story Behind Silver's 30x move from the Daily Reckoning. It really lays out the timeline, introduces the key players. So, our mission today: unravel this wild ride, understand the powerful forces at play, and crucially, see what lessons you can maybe extract from this legendary market event. Okay, let's dig in.
Indeed. It's a story that brilliantly highlights the complex interplay of, big macroeconomic shifts, the unwavering conviction of certain individuals, and the very structure of financial markets themselves. We'll be looking at how silver went from around, the $1.60 an ounce in 1970 to nearly $50 by 1980. And more importantly, why that happened. What's really fascinating here is how much of this story is shaped by the broader economic environment of the time, not just the actions of a few specific people.
That sets the stage perfectly. So before we jump into that huge rise, what was the landscape for silver like leading up to 1970? The article mentions a collapse in monetary demand. That sounds pretty significant.
Absolutely. A crucial piece of background is that the U.S. and other countries, they started phasing out silver in coins around 1965. Before that, American dimes and quarters, for instance, were 90% silver, real silver.
Wow.
So when that changed, the market was actually flooded with these massive government stockpiles of the metal. This, plus, savvy collectors melting down old silver coins for their value, it temporarily boosted supply and initially kept the price down. But underneath all of that, something else was quietly building. This rising tide of inflation and a growing demand for what people call hard money, assets like gold and silver, things with intrinsic value.
Things not just printed by governments. And then came a monumental shift in 1971, didn't it? That must have really shaken things up.
Oh, yeah. Here's where it gets really interesting. In 1971, President Nixon, he made the huge decision to end the gold standard completely. This meant that what we call fiat money, basically currency backed only by government decree, not gold or silver, was completely free from the constraints of hard assets. The dollar,
Right.
no longer convertible to gold by foreign governments. And our coins were now made of, cheap copper and nickel, not valuable silver. This move basically removed the last official tie to precious metals. And it really set the stage for people to start looking for other ways to protect their wealth outside of just holding dollars.
So with that backdrop, economic change, currency worries, this is where the story introduces the figures most often associated with this whole saga.
Right.
The Hunt brothers.
Yeah.
Who were they? And
Well-
what was their motivation to get into silver on such a massive scale?
Right. Enter William Lamar and Nelson Hunt, sons of the legendary oil tycoon H.L. Hunt. They were incredibly wealthy, obviously, and importantly, deeply concerned about the effects of fiat money on the U.S. economy, especially inflation. They firmly believed silver was, and I think the quote was, criminally undervalued at around $1.50 an ounce back in 1970.
Wow.
Yeah, and that's exactly when they started building their position. Their strategy, though, it evolved quite a bit. Initially, they just bought physical bullion, bars of silver, stored it in vaults, took direct ownership. Pretty straightforward. But eventually, they got much more aggressive. They started buying silver futures contracts, agreements to buy or sell later at a set price, and using leverage liberally.
Okay, hold on. They started with physical silver, then switched to futures. That sounds like a huge shift. And using leverage liberally, what does that actually mean for listeners, like in simple terms?
Good question. It basically means they amplified their potential gains and, crucially, their potential losses by borrowing money. Leverage let them control a much, much larger amount of silver with a relatively small amount of their own cash up front.
So a small price move could mean a huge profit or a huge loss.
Exactly. Much bigger swings.
That kind of exposure sounds incredibly risky. So how did their aggressive buying, especially with those leveraged futures, impact the price? The article says it was more like a roller coaster, not a smooth climb.
You're absolutely right. It was far from a straight line up. By 1974, silver had reached $6.40 an ounce, which was a good move from $1.50.
Yeah.
But then it actually took a dive, entered a brief bear market, fell back to $3.80.
Ouch.
Yeah. And the Hunts famously bought that dip aggressively, doubled down. Yet, even by the end of 1977, the price hadn't really gone anywhere spectacular, stuck around 4.90 cents. End of 1978, only about $6.20.
Wow, that sounds like it required almost unbelievable patience. And deep pockets, I guess.
Definitely both. Immense patience and conviction.
But by this point, were those government stockpiles still hanging over the market?
Not really, no. By then, those huge government stockpiles, like I think it was 3 billion ounces the U.S. government sold off, they were largely gone, exhausted. Precious metals weren't officially part of the money system anymore, but individuals were starting to create their own sort of personal hard money policies, buying silver and gold themselves. And of course, the Hunt brothers just kept buying and holding, waiting for that breakout.
And then 1979, the article says things just exploded higher. Sounds like the market finally caught up to their thinking, or maybe something else happened.
Yes, 1979 saw an absolute explosion. The price of silver shot up from around $6 an ounce to $25.
Wow, $6 to $25 in a year.
In 1 year. And then by January 1980, things had gone completely bonkers. It doubled again from $25 to nearly $50. That was the peak. For that cycle, anyway. Which brings up a really important question the article pushes on. While the Hunts definitely played a big role, the article argues their influence is often exaggerated. So what else was going on? It couldn't have just been them.
Ah, okay, that's a key distinction. And it makes perfect sense when you look at the wider picture. The article points out it was hardly a coincidence that inflation peaked around a staggering 14% in 1979.
14%. Imagine that.
Right. So it wasn't just speculation from a few rich guys driving the price. Ordinary Americans were genuinely desperate to find anything that would protect their savings from, evaporating purchasing power. And silver, alongside gold, seemed like the obvious choice. It sounds like a powder keg, really. Economic anxiety just simmering, waiting for a match.
Precisely. A perfect storm in many ways.
So the Hunts amassed this huge amount, roughly 200 million ounces, through physical metal and these futures contracts. Given their massive position, what ultimately brought them down when silver hit nearly $50?
Well, ultimately, it was the futures contracts that did them in. As we said, they'd bought vast quantities on the COMEX exchange. And that leverage, which had worked so well on the way up, well, it cut both ways.
Right. So what did COMEX, the exchange itself, do when silver hit that peak? It sounds like they had to step in somehow.
They certainly did. Drastic action. In 1980, with silver around $50, COMEX basically put the brakes on hard. They brought in a new rule, liquidation only. Traders could no longer buy new silver contract. They could only sell or liquidate existing ones.
Wow. Okay, so you couldn't pile in anymore, only get out.
Exactly. And on top of that, they significantly raised the margin requirements for silver contracts.
Ah, the margin requirements. So basically, they forced the Hunts and anyone else, long silver futures, to put up way more cash just to hold on to their existing positions, right? That's the margin call.
Precisely. You got it. And when you can't meet those sudden, much higher calls, your broker forcibly sells your positions to cover the difference, often at terrible prices in a falling market. For silver longs, people betting on the price going up like the Hunt brothers, it was catastrophic.
A disaster.
Total disaster. Silver crashed from that peak near $50, $49 or 45 technically, all the way down to $16 by the end of 1980. The Hunt brothers were subsequently sued by regulators, declared bankruptcy later on, lost the vast majority of their fortune, largely because they chased that extra juice, that leverage, which made them so vulnerable to rule changes.
So, if we step back from the drama, what does this whole episode tell us about how this event is usually understood? Because the narrative is often just, the Hunts tried to corner the market and failed.
Yeah, and while they definitely played a central dramatic role and often get the blame for the silver bubble, the article strongly argues they were just one part of a much larger movement. The 1970s silver squeeze was actually far more decentralized than the pop culture version suggests. Many, many people were fed up with fiat currency, loved hard money, and they were buying silver too. Maybe not on the Hunt scale, but collectively,
It adds up.
it adds up. The core mistake the Hunts made, according to this view, wasn't believing in silver, but getting so heavily involved with those highly leveraged futures contracts. Because, as the article points out, COMEX and other futures exchanges, they explicitly state in their fine print, their terms of service, that they can change the rules anytime, for any reason.
That's a sobering thought for futures traders.
Absolutely. Without that heavy futures involvement, the article suggests silver's path might have been much smoother, more sustainable, less bubbly.
That's a really crucial distinction
Yeah.
and a powerful lesson about market rules and leverage. So if that was the untold story, what does the article suggest for a, quote, better silver squeeze in the future? What would that look like?
Well, the article posits that the next silver squeeze, if it happens, won't be driven by futures or margin debt like in the 70s. Instead, it predicts it'll be driven by potentially millions of individuals, maybe feeling similar pressures from inflation or fiat currency concerns, buying physical silver bullion, coins, bars,
The actual metal.
the actual metal. The key difference being that physical silver in your possession can't be manipulated by exchange rule changes like futures contracts can, unless, the government itself steps in to restrict buying or selling, which the article thinks is highly unlikely. So the advice for silver bulls today, according to this source, is clear. Keep buying and accumulating physical silver bullion and maybe look at high-quality physical ETFs like the Sprott Physical Silver Trust, PSLV, which holds allocated metal. The idea is the next surge will be driven by genuine broad-based demand for the real thing, not just paper speculation.
So a kind of grassroots movement for physical metal, not a speculative bubble led by a few big players.
Yeah.
That's a really interesting outlook. And what's the current view on silver right now, according to this source? We're sitting here in July 2025.
Yeah, the article asserts that silver, even now, remains well below its old highs from 1980 and also 2011, which were both near $50. Even as we enter what it describes as a period likely to be chaotic and full of money printing, silver is still considered, quote, dirt cheap and potentially poised for a significant move.
Dirt cheap. Okay. Does it give a target?
It does. The author sets a pretty compelling price target of $120 an ounce by 2028.
$120. That's quite a jump from where we are now. What's the reasoning?
It's multifaceted. First, mined silver supply. Barely growing. Recycling. Still sluggish. But industrial demand for silver. Never been higher. And it's only set to grow with things like solar panels, EVs, electronics.
Right. All the green tech uses a lot of silver.
A huge amount. So basically every year, the market is consuming significantly more silver, around 160 million ounces more than is being produced through mining and recycling combined. That deficit eats away at existing above-ground stockpiles.
Okay, so supply is tight, industrial demand is soaring. That alone sounds pretty bullish. But what about investment demand, the kind that really drove that 1970s squeeze?
That's the kicker. Investment demand, according to the article, is just starting to wake up again, and it's expected to grow significantly. That's seen as the real difference maker in the supply-demand equation moving forward. The article concludes that eventually those above-ground stocks of readily available silver will dry up, which could make even that $120 price target seem potentially conservative. It calls the current situation an explosive setup and believes the bull market in silver has, quote, only just begun.
What an incredible deep dive into the history and potentially the future of silver. From, government policy shifts and people just trying to protect their wealth to the dramatic actions of those brothers and the market's role in their downfall. It's really clear that understanding these forces is pretty crucial for navigating assets.
Absolutely. And if we connect this back to the bigger picture, the story of silver is such a powerful reminder, isn't it? That while, individual actions can have these huge outsized effects sometimes, it's often the underlying macroeconomic conditions, the inflation, the currency issues, combined with those often overlooked rules of the game in the financial markets that truly dictate the outcomes in the long run.
Yeah. And as we've seen, the market for actual physical stuff can behave very differently from paper speculation, especially when those rules of the game can change on a dime, like they did with COMEX. It really makes you wonder, doesn't it? If the next silver squeeze, as this article suggests, is genuinely driven by millions of ordinary people buying physical metal because of fiat money worries, what are the broader implications for central banks, for policy down the line, and maybe what other physical assets out there might be poised for a similar kind of supply-constrained surge? Something to think about until our next deep dive.